Hi guys, Max here, and this is of course your daily update for yesterday, the 27th of June. It was the first day of the week after that weekend. So how did stocks and equities perform? Well, they didn't do brilliantly, but they didn't do awfully. As you can see here, it was sort of a mixed bag, but there wasn't any consistent route across the board, so it wasn't awful. The S&P 500 in the end fell by about 0.3%, and the Nasdaq did a little bit worse and fell by about 1%, but it was quite a volatile day with some 1% gains at some points and then ending up with stocks in the red for the most part. The Dow Jones did a little bit better than the rest of the markets and only fell by 0.2%, and this is mostly because energy stocks actually did really well. If I pull myself out the way here, you can see at the energy index here, green across the board, most energy stocks up by 2, 3, 4, some even as much as 7% for the day. As for the rest of the world then, what happened everywhere else? Well, it was a similar sort of story, but a little bit better for the most part. A mixed bag still, lots of individual companies moving in regards to their own developments and pieces of news. And on average, actually, stocks did rise across the rest of the world. The rest of the Americas was relatively strong. Europe was up by 0.8% in the UK for the FTSE 100 and 0.5% for the rest of Europe for the Stoxx 600. Asia did okay as well. On the whole then, the MSCI World Index actually rose by 0.3%. Now, what was causing this weird volatility and why did a lot of stocks move in their own individual directions rather than moving in regards to how the economy is going to perform? Well, the general idea that's going around is that a lot of investors are rebalancing their portfolios in preparation for the end of the first half of the year. And so that's why a lot of stocks were moving either up or down, but not in any one concerted direction. And if this is true, then we should expect consistent volatility over the next few days until we reach the new half of the year. Now, the dollar spot index was actually mostly unchanged. The dollar didn't really rise or fall for the day. The euro rose very slightly by 0.3%. It's now at $1.06, still around that rough mark where it has been over recent weeks. The pound was also in that same sort of place, sitting at $1.23. So no major moves for foreign currencies. In the world of fixed income assets for bonds and bond yields, well, yields rose across the board. The US 10-year Treasury yield rose by 7 basis points to 3.2%. The German 10-year yield rose by 10 basis points and the British rose by 9 basis points. So we saw outflows from the bond markets in general. It could be that we're finally seeing the effects of quantitative tightening, that the Federal Reserve's balance sheet is finally being wound down, or maybe people just aren't very confident about the bond market yet. Now, for commodities, oil prices rose as you would expect them to after seeing energy stocks rise like they did. WTI crude oil rose by about 2% and is now back at $110 a barrel. Brent crude oil is at $113. This shouldn't really be surprising to you if you watch this channel. The downwards action that we saw over the last week or so was really in preparation or speculation of a worldwide recession that would dampen oil demand, but we're not actually at that point where oil demand is being cut away yet, so prices have started to rise again. Finally then, for traditional financial markets, what happened in the gold market? Well, gold prices fell very slightly by about 0.5%. They're now sitting at about $1,825 an ounce. As for the crypto market then, what happened over there? Well, it looks very bad from this chart. Everything's red as you can see. But in reality, crypto was actually up for the most part over the weekend. And so this is mostly just coins losing the gains that they made a couple of days before. Bitcoin just above $21,000 and Ethereum just above $1,200 really isn't so bad compared to what we saw last week. We had Bitcoin touching $17,000 at a couple of different points. So this really isn't actually as poor as it looks. Now, we did actually get a little bit of news about the crypto market. Nothing was really strong enough to change how it performed, but something that is important nonetheless. And it came out of the SEC chairman from the US, Gary Gensler, who basically said that he is willing to call Bitcoin a commodity. He has reaffirmed that position. But in particular, he said that he's only willing to call Bitcoin a commodity, and he doesn't feel that same way about other cryptocurrencies. Now, this comes down to this idea of trying to regulate and categorize cryptocurrency. They are new assets and no one really knows how best to regulate them. And so a lot of people and a lot of organizations are looking at categorizing them as either a commodity or a security. And it isn't a open and shut case. It isn't clearly one side or the other. But from what I see and from my opinion, I would rather cryptocurrencies are categorized as a commodity as opposed to a security. And most people in the crypto space seem to agree with me, I think. So this is quite nice to see for Bitcoin in particular, but not really for the rest of the crypto market. In the past, Gary Gensler has come out and said that actually he considers and thinks of Ethereum as a security, although that was about 4 years ago right now. Now, I personally see Bitcoin sort of as digital gold, so a commodity would work quite well. I don't see it as a form of real currency. I don't like the idea of layer 2 programs to try and make it into a currency. And so I think that actually it being categorized as a commodity is good for Bitcoin in the long run. Some other far more educated people than myself have come out and said what they think. Charles Hoskinson, the guy behind ADA, has come out and said that he opposes either cryptocurrency being considered a security or a commodity. He says that it isn't a binary issue, that there is far more to consider, and that they probably require their own new regulations and new categorizations. Now, I do actually agree with that as well. I wouldn't be at all opposed to seeing a brand new set of regulations set out for cryptocurrency because they are unique assets and maybe we need new rules to suit these new entities. Now, moving on to normal business and investing news for the day, we have some very bad news coming out of California from none other than Gavin Newsom, and you can probably tell what it is from this headline here. 23 million Californians to get up to $1,050 in inflation relief checks. Basically, Gavin Newsom wants to send out more stimulus checks in California to try and counter inflation. If I look a little bit perplexed there, that's because I am. This is one of the stupidest ideas I've ever heard in my life. Stimulus checks are one of the main reasons why we have seen such massive levels of inflation in the US, and sending out more stimulus checks will only make that inflation worse. It is very clear that Gavin Newsom and the California government in general obviously haven't learned from their heinous mistakes. This will simply increase demand. It will cause buying pressure for goods and services in California to increase. And because there's still a supply side crisis all over the world, but in California as well, companies will not be able to increase the supply of those services or all those products to try and make up for that higher demand. And so instead, prices will simply rise. Now, the worst thing about this is that obviously this man is an elected official. He's been voted into this position, and for some reason it seems like Californians on the whole actually agree with him and his policies, meaning that there's really not much that can actually be done about this. We just have to sit back, relax, and watch California go up in flames because of the person they voted for and the actions that they decided to propose. Now, in business news, we had a major company, Nike, come out and put out their earnings report, and it was actually really strong. Despite inflation, as you can see here from this CNBC article, everyone was sort of expecting it to be a little bit damped. Inflation is a worry, and the supply side crisis is a worry for Nike as well, and so earnings weren't too optimistic. But actually, Nike came out and did really well, and they beat both their earnings and their revenues expectations. You can see right here, earnings per share was 90 cents versus 81 cents expected, and then revenue was 12.23 billion as opposed to 12.06 billion expected. A very strong performance for Nike. Now, of course, they came out and said a few things about their business and how things are going and how they expect them to go into the future. And this is where actually things start to not look so bright. They basically said that no, inflation isn't hurting us yet, but they're very worried that it will. They are very aware of higher transport costs and how that's going to impact their costs. And they're also particularly worried about longer wait times for their products. The supply side crisis isn't getting any better, and they know that as well. So how did investors react to this relatively strong news with a somber note? Well, Nike's share price fell by about 3% after hours on this good earnings report. Now, this is worrying for a number of reasons, not only for Nike itself, because it shows that just the sentiment surrounding this company isn't very strong, but really, this is the kind of thing that I expect to see across most companies as we enter the next earnings season. Relatively strong results, companies beating expectations, but still their share prices fall because investors just aren't sure that these strong results are good enough to counteract the poor macro environment that's affecting the economy, the higher inflation, the lower consumer spending, the lower levels of credit card debt, higher interest rates, and things like that. Now, finally for the day, just a little bit about Russia, who have, of course, defaulted on their sovereign debt. I made a longer video talking exclusively about this issue yesterday, so go watch that if you haven't already. In very short, though, they had a $100 million bond payment that was due about a month ago. They couldn't pay it then, and now their 1 month grace period is up, so they are now officially in default. Now, this is very controversial because, in short, Russia has the money to pay these investors. They want to pay these investors, but Western sanctions make it impossible for Russia to pay these sanctions. As a result of this, Russia is very unhappy and they're kicking up a lot of stink. They're saying that this is a fake default, that it isn't a real default, and that it doesn't matter. But the reality is, it doesn't really matter why Russia hasn't paid their investors. The only important factor here is that investors haven't been paid. And so in the future, when Russia looks for more investors, well, they're going to struggle to find them because it doesn't matter how strong those investments are, how reliable the Russian government is. If the American government is holding a gun to your head, threatening you with imprisonment if you accept your investment back, well, there's just not really an investment case for then helping the Russian government take out loans. Now, in the short term, this really isn't an issue for Russia at all. The government is fully solvent. They don't particularly need to raise any capital at the moment, and not having to pay their investors actually isn't the worst thing in the world. It just means they're holding on to more of their cash. But in the long term, this will turn out to be a major issue if these sanctions stay in place, because as I said, it will halt foreign investment into Russia. It will make it harder for the government to raise capital, to release sovereign bonds and things like that. And that will end up being a major problem if these sanctions stay into place for years into the future. Again, I go into way more detail surrounding it in the video I put out yesterday, so go check that out. Link will be down below in the description as always. And of course, whenever I talk about Russia, I get a lot of negative criticism because people don't like my takes on geopolitics. But actually, the most important thing that I've spoken about regarding geopolitics, regards to the West versus Russia over recent months, hasn't been, how the war in Ukraine is going, because frankly, it doesn't matter how I think the war is going. It doesn't matter what I think is going to happen. All that matters is what happened yesterday and what's going to happen tomorrow. And the important thing that I predicted would happen was that tensions between the West and the East would continue to deteriorate as the war continued, and that has without a doubt happened. Now, this has just escalated once further because NATO, as you can see from this Politico article, have announced that they're going to increase their high readiness force in Eastern Europe to well over 300,000 troops. That's up from about 40,000 troops that we're at the moment. Now, again, please try not to get into this about picking a side. This isn't a football game. You don't need to have a team you support. It doesn't matter if this is a result of the US, the UK, of NATO, or the EU, or Ukraine, or Russia. It doesn't matter who's at fault here. The only thing that matters is that the military presence of NATO in Eastern Europe is about to increase, and Russia is going to be unhappy about this. Tensions between East and West will deteriorate, and so sanctions are likely to continue into the future. And so all that matters, this is a finance channel, is how that is going to impact the markets and the economies of our countries into the future. If you are an investor in a company like McDonald's, for example, and you bought into the company because you thought that it took too much of a share price hit when it had to leave the Russian market, and you were hoping that they would re-enter the Russian market into the future, well, this kind of action from NATO of increasing the number of troops close to Russia is going to worsen tensions and make it less likely for companies like McDonald's to move back into the Russian market. These are the kind of things that are actually important and that we should actually be paying attention to, not trying to assign blame to one side or the other, because frankly, no one cares what we think about who's actually at fault regarding this war, this conflict, and the deteriorating tensions. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.